Hi, everybody. I'm Hugh Johnson. As you know, I'm the chairman of Hugh Johnson Advisors, and I want to, as we close out the year and look forward to the next year, I want to just give you a little bit of a perspective on what I see going on. First of all, of course, in this very difficult fourth quarter that we've had of 2018, and then looking ahead to 2019, give you an idea where I think things are going. Above all, I want to wish everybody a great 2019 and 2020. Hopefully things will be better, but we'll obviously have to manage maybe perhaps a little bit more difficult financial market environment. You know, we really, when you take a look back at the fourth quarter of 2018, in fact, you look at the entire bull market that, of course, started in March of 2009, it's been quite a bull market. When I take a look at the numbers, and these are just numbers, but if I take a look at the numbers, the average annualized rate of gain in the stock market since the bull market started through the third quarter of 2018 was about 17%. That's a big number, especially when you compare that number with the long-term average annual return for the stock market when we go back to 1890. That's been about 9%. So you can see that to a great extent, the 17% was a big number. And the fact that we had a decline in the fourth quarter of 2018, a pretty sharp decline, a pretty nerve-wracking decline in the fourth quarter of 2018, we effectively gave back some of those really unusual gains that we've had during this bull market. So quite frankly, yeah, sure, I don't like seeing it. I don't like being a part of it, but nevertheless, to some extent, it's really a sort of a rational give back of some of the really unusual and outlandish gains that we've had since 2010. Along the way, you're going to have these kinds of corrections in ongoing bull markets. I think that's the big question right now. Is there more to come? It wouldn't certainly surprise me if we did have more to come, in the sense that we did give back some more of those gains. There are reasons to believe, however, and I give this as a forecast perhaps, but more a suspicion than anything else. Nobody really knows. But there are reasons to believe we could be somewhat optimistic about what the market's going to do in the first quarter anyway of 2019, and maybe all of 2019. First of all, we haven't seen the stock market decline anywhere near to the level of undervaluation that we currently have. We haven't seen it since really the stock market crash of 1987. I was a part of that stock market crash. I testified in front of Congress, talked about that crash. It was really something to behold. We really haven't seen this level of undervaluation since the stock market crash of '87. And keep in mind that after we saw the stock market crash in 1987, we saw a substantial rally in the stock market for the next 3 and next 6 months. I wouldn't be surprised to see not a substantial rally, not given the kinds of market performance that we've seen in this bull market, but I certainly wouldn't be surprised to see some improvement in stock prices from this point forward or in the first quarter of 2019. And that's particularly true because we've got a lot of earnings coming out in the first quarter of 2019, and they're likely to be fairly good numbers, or we're going to be looking at some, I think, fairly good numbers, although everybody's going to be very cautious about forward guidance or telling us what lies ahead in 2019, because indeed the economy is in the process of slowing, or will be in the process of slowing in 2019. But nevertheless, the numbers should be fairly good. The second thing is that I've never seen a level of pessimism as I've seen now, objectively quantified. There's only 20% of the individual investors that are stock market buyers are bullish on the stock market. Historically, when you get to that level, the next thing that happens, next 3 to 6 months, is you get not great returns, but somewhat better returns, or positive returns. So there's a reason to suspect that the first quarter of 2019 isn't going to be anywhere like the fourth quarter, the very difficult fourth quarter that we've just gone through. The question is, what are we doing about it as far as portfolios are concerned? As I've told you, even though I'm somewhat optimistic that this is just sort of a severe correction, a correction that's been clearly aggravated by professional trading or trading in derivatives, Even though I look at this as a correction in an ongoing bull market, that there might be good things ahead in 2019. As we've said to you in the past, we always respond to things that are going on in the financial markets. And when the markets are deteriorating, then we'll reduce the exposure of our clients to equities in order to try to defend their portfolios or to preserve capital. We did that essentially in the fourth quarter. Most of you clearly know that. We've reduced our exposure to technology. We've moved to from some consumer staples stocks and healthcare stocks into better consumer staples and healthcare stocks. We've reduced, as I mentioned, our industrials. We've reduced our basic materials. We reduced our asset allocation in all portfolios. Again, despite the fact that Hugh Johnson in his reflective moments thinks this is only a correction in an ongoing bull market. So we have taken steps that have essentially responded to the declines that we've seen in the stock market, or the trends in the stock market, to try to take steps to preserve capital. You never, of course, when the market's going down, take enough off the table or reduce equity exposure enough. I always look back and say, I wish I'd taken more off the table. I wish I'd reduced equity exposure more. But that's the way that goes in this business when you take steps to actively manage portfolios. Again, looking forward to the next year, this is very difficult in some respects because, as I've told you in the past, we're at the 118-month mark of this bull market. It's the longest bull market in history, and of course, sooner or later, this bull market's going to end. I don't think it's ended yet, but it's going to end sooner or later. Trees just simply don't grow to the sky, as I've mentioned so many times. So at some time it's going to end, and we're going to have a bear market that's accompanied by a recession. I frankly don't believe that the bear market or the recession is going to be anything like anything near as severe as we saw in the 2007, late 2007, 2008, early 2009 period. That was the Great Recession, very unusual in our financial market history. I think it's going to be a lot less than that. Keep in mind, bear markets are nowhere near as long as bull markets. Bull markets on average last about 60 months. Bear markets last about 16.6 months on average, and certainly are not anywhere near, don't have anywhere near the kind of price change that you see in a bull market. You get declines maybe around 25%, and we've had close to 20% in this correction. Point being, these are a lot of numbers, is that sure, we're going to go through some more tough times. We'll manage through those tough times. The long and the short of it is there's a lot of things. We're going to obviously actively manage to try to preserve your capital. Keep in mind, probably the most successful investors I've seen over long periods of time of being at this are the ones that essentially go through periods like this and hold on, recognizing that the average annual returns from stocks over long periods of time, going through lots of bear markets and lots of severe corrections, has been 9.2% since 1890, or around 9%. Maybe it'll be a little less than that in the future, but nevertheless, my guess is it's still going to be a pretty good return. And that's, again, importantly, when you go through lots of corrections and lots of bear markets, which are simply a part of our financial market lives. So those of you that are sort of the buy, hold, the tough it out types, I think that's often a really good strategy. As I've often said, very sort of summarized it in the past, it's really time, not timing, that's the secret to success. Overall, from us here, looking at 2019, we really appreciate the confidence you've shown in us. These have been difficult times, a difficult fourth quarter, but we're going to get through this quarter, and we're going to go on to, I think, in my judgment, in the months and years ahead, some pretty good quarters. So thank you very much for the confidence you've shown in us, and you can bet that we're going to continue to work in 2019 as hard as we always have to try to give you good returns and to help you meet your objectives and goals. Thanks again for your confidence. If you have any questions, call me, call Dan Nolan, the president of the firm, call anybody at Hugh Johnson Advisors. And we look forward to seeing you, talking to you, hearing your comments, hearing your suggestions. And again, we look forward in particular to walking through, going through, moving through some much better times in 2019 than the fourth quarter of 2018. It's good to have that one in the rearview mirror. Thanks a lot.